from month 1 through 6. You want them to come on board in month 5 and 6. You follow me? Where everybody says, I gotta be there, and they join in late. It came sooner than we expected. We have various reasons, I probably talked about in the last show, of why we think this move in silver. But we're only month 2 into it. In the last day of that month, we had a huge collapse. Came a little sooner than we expected. We kind of thought maybe late February, early March, and it was deeper than expected. The dollar is a constant piece of decay anyway. Look at M2, you can see how much supply increases every decade, like 80-90% supply increase. Therefore, its real buying power continues to collapse decade by decade. It came sooner than we expected. We have various reasons, I probably talked about in the last show, of why we think this move in silver, the bell rang in the close of November for us, meaning that's where the point of massive acceleration was likely to occur. So December would be month 1, January month 2. In hindsight, looking back at various markets who've undergone similar things, quite often these surges, and there's reasons for this in silver as well, are spent in a couple quarters, either side of a couple quarters, 5 months, 7 months, something like that, where you see the massive move that it's going to make done quickly. Oh, there might be some more later, but that's not the point. The point is the massive surge, the rebirth to a new reality for silver. But we're only month 2 into it. In the last day of that month, we had a huge collapse. Came a little sooner than we expected. We kind of thought maybe late February, early March, and it was deeper than expected. But in hindsight, when I go back and I look at a lot of my momentum charts, again, you can look at price if you want, that's fine. But when you look at momentum, often you get a different picture. And that pullback made a lot of sense, actually, where it went to, both on gold and silver. And lo and behold, that was the low so far that occurred Monday morning. The follow, and it was a day and a half collapse, really. It was the last day of last month and then the first day of this month. But we got to certain levels on silver and gold, which made sort of sense. Oh, they pulled back to there. Oh, that makes sense. Yes, it was dramatic to get there. Since then, we've gelled. We've had up and down action. And frankly, where the rally peaked so far this week, up above $90 in silver, made some sense too. And then we pull back from there. So we've more or less set a structure, so to speak. One, we held a key long-term support level, actually an intermediate-term support level, month, 3-month average on silver to the penny. Okay, we hit that on Monday. And we came back and retested today. If you take it out a little bit, it doesn't bother us. But that was an interesting area to stop at because we have not seen that rising moving average, a 3-month average, which is not a common tool. We use it. We've not seen that in since 8-9 months in silver. So, I mean, it hasn't even come back down and kissed that rising average. So it made some sense to us. Okay, that's step 1.
Across the developed world, sovereign debt levels have risen to historically unprecedented peaks. Investors now live with the possibility that government balance sheets could introduce systemic vulnerabilities into global markets. Some analysts warn that if confidence weakens, traditional asset correlations could break down. This looming unease feeds demand for instruments seen as alternative stores of value, especially when paper assets are perceived as overstretched or at risk from policy shifts. Amid this backdrop, silver's dual role as both a commodity and a hedge becomes increasingly relevant in investment strategies.
What we're looking for now is some gelling action. No, I don't think we're going to go zapping back to the high within weeks. I think it may take more like much of February to work our way back up, to restabilize a lot of expectations as well, but to restabilize the market and generate some buy signals on the way back up based on short-term metrics. And those numbers are set. For instance, you don't want to, if you're a bear, you do not want to wander back up late this week and into next week into the upper 80s again on silver. We were up to over 90 the other day. So you don't want to go back up there again. If you do, then it's over. You're going back up, okay? And I think that's about to happen. But again, I don't think it's an explosion back to the high. I could be surprised. I think it's more like an arm wrestling match to get back up there, and probably by March, then you're challenging the highs again, and which game on again, in other words. That would have been your midpoint jiggle. And I still think that the likely massive percent of any gain we're going to see, and again, I think it could be in the couple to several $100s on silver easily. I don't have a precise number. Will occur by early summer.
Silver has endured dramatic swings over recent years, at times sharply underperforming other precious metals despite strong industrial demand. Chart patterns and sentiment indicators reflect a market reset rather than a simple pullback. Some traders argue the price action represents a consolidation phase, with potential for significant upside if key technical thresholds break. These patterns suggest that silver's price behavior is being rewritten, influenced by broader macro forces rather than isolated supply shifts. Discussions across investor forums highlight the anticipation for potential breakouts once volatility finds its direction.
Give or take a month, okay? These same type of events, this explosive couple quarter surge, also occurred for silver back in 79 to 80 when it went to $50. In 5 months, you quadrupled silver in 5 months to get to 50. Again, that was within that old reality of $50 highs. And then again in 2010 and 11, there was a last surge of a multi-year bull market in silver, where in September 2010 through April 2011, silver doubled in half. Okay. In 7 months, so 5 months, 7 months, either side of a couple quarters. And we could find this behavior pattern in other markets, and I mentioned this last time, but we won't reiterate that. But right now, I think, one, yes, the correction is either over or largely over. Two, it won't take much to put a real thumbs up on this situation, like, okay, we're going back up. I don't think the back up means rapidly. I think it could be arm wrestling. That's fine. But by March, if we have a stable February, which so far I think we're going to see, then by March you should be back at your highs. And at that point you go ballistic. Except this time you will have shaken out a ton of people and created massive amount of doubt, which is great. And you want the doubt because when you get these kind of price surges, you don't want everybody on board from month 1 through 6. You want them to come on board in month 5 and 6. You follow me? Where everybody says, I got to be there, I got to be there. And they join in late. Well, the long term could, there's so many big events out there that are going on right now. The stock market, I believe, is topic. Right now, I do believe the stock market is yet to make its high. I know there's been a lot of selling pressure on the S&P just below 7,000, for example. I think you're likely to pop through that and get a big cheer from the crowds. It won't be much. It's underperforming gold and the silver, even with their pullback. If you go back 4 or 5 months and look where gold and silver are versus, and look at the S&P where it was 4 or 5 months ago, it's sideways.
Unlike gold, which is viewed more strictly as a monetary asset, silver's industrial footprint is growing. It's integral to solar energy systems, electronics, and emerging technologies that require unparalleled conductivity. As green energy transitions accelerate, so too does demand for physical silver. At the same time, some institutional and long-term buyers are accumulating tangible metal as a strategic allocation, hedging against inflation and market uncertainty. This heightened interest transcends speculative trading and reflects real economic demand for the metal itself.
Catching up to a price level that would be reflective of, for example, the decay in the money unit, or reflective of what gold has done for 50 years, meaning higher and higher highs, not capped off for 50 years. But, when you look at silver and you see a 50-year range, $4 to 50, $4 to 50, and yet other markets during that same time didn't stop at the 1980 high, didn't stop at the 2011 high. Look what copper did for decades. I've mentioned this before, 50 cents to $1.50 for decades and decades. When it broke through in a couple quarters, it went to $4.50. It's back in 2006. Lead did the same thing in 2007. Gold, the mama market of the monetary metals, has not restrained by the 1980 high, nor the 2011 high, where silver was. Why? It just doesn't make any sense. If copper can blast into highs above a multi-decade range, why can't silver? Well, it reeks of manipulation. The question now is, did this break occur that way? I think too many analysts, including those who are friendly to gold and silver, fundamentally friendly, are using old metrics. Now, they're going back and looking at their charts, 1979 to 80 and 2010 to 11, and they're seeing these massive up moves, of course, confined in that old range. And yet they looked at their metrics that they might have on their quote screen, like, let's say, RSI, for example, a very popular free tool. Okay. It gets above 80 or something on a monthly close. Oh, that's overbought. Well, old norms are going to be shattered in this move. Just like price has shattered the old 50 highs, you're going to break old norms of what is overbought. And we show this in annual momentum charts of silver and gold. What used to be the old highs, like the 2011 high and the 2020 surge high. And you look at momentum charts and you say, oh, see, they sort of capped at the same level. Well, we blew those off the page. So what the market has said is old notions of overbought are incorrect. And therefore, people who take profits based on that, for the moment, they feel wise. We're arguing no. Ultimately, they're going to have a real problem. Do they actually get back in? And if they get back in, do they get in better than where they got out?
Market commentators with deep experience, including those who correctly anticipated past financial inflection points, are now signaling that silver could be poised for a multi-year uptrend. Their perspective isn't based on price charts alone, but also on macroeconomic signals such as monetary policy shifts, currency weakness, and debt stress. These narratives influence investor behavior, drawing attention not just from retail audiences, but also from institutions reassessing risk and reserve allocations. Whether these calls translate into sustained price increases remains debated, but the conversation underscores silver's heightened prominence.
The be-all, the silver's a surfer, and he's riding on two waves. Now, right now, everybody knows about the industrial supply-demand deficit. That's been made clear to investors. And so, and the China situation. But it's money. It's also the baby of gold. 3,000 years it's been that. Don't dismiss it. And when the world gets shaken by this and that other event, like the decline in the dollar's reserve status versus other fiats, the questionable nature of U.S. government bonds, and especially Japanese bonds or U.K. bonds, these are crises bubbling on the edge. And the monetary metals know that. And they're not going to wait for the event to happen in this category or that category. They're already building in their anticipation of those events aren't going away. It's just a matter of when do they burst.
Looking forward, the future of silver markets sits at the nexus of economic resilience and structural change. If governments continue expanding debt and central banks maintain accommodative stances, real assets like silver could become increasingly attractive. Conversely, macro tightening or shifts in industrial demand could temper the pace of movement. For investors and observers alike, this period is defining. Will silver's rebirth be marked by gradual normalization or by explosive revaluation? The answers may lie in how broader markets interpret risk, value, and the role of physical versus financial assets in portfolio construction.
And all these things will come and go, and there'll be exciting points, or they might be negative points from time to time. But really, they're not part of the big process. And the big process is there's two waves that silver's on. One is the industrial one, but it's the money. That's the bigger wave underneath the monetary metals. And so silver's got, it's a double-barreled situation, whereas gold is unibarreled, okay? It's the money metal. But all these little factors that we can cite day to day that pop up as headlines or data points, yeah, they're interesting, and some will be negative and some will be positive, but they're effectively noise in a much bigger situation. The dollar is a constant piece of decay anyway. Look at M2, you can see how much supply increases every decade, like 80-90% supply increase. Therefore, its real buying power continues to collapse decade by decade. That's true with the euro and the yen. Okay, so when you compete those pieces of fiat with each other, the technicals right now indicate, the dollar's going down. Now, right now it's struggling to hold, but it's already broken long-term momentum trends. And the price trend is also now in jeopardy, where anybody looking at a price chart going back to 2010 on the dollar index says, oops, we're below the line. Okay, that's one factor. It's not I consider that actually lesser of the fundamentals. The relative value of the US dollar versus the euro or the yen, which is what the dollar index is basically. The other one is the government bond market. We know we have a crisis building there, even in the U.S. Jamie Dimon said that months ago. You can't keep pushing this down the road. Ultimately, it'll resolve in some noisy way if you don't take care of it. And of course, it can't be taken care of very easily, if at all. The Japanese have demonstrated that. They're in crisis mode. They're trying to put out fires. Well, and we also know this is true with like the UK and so forth. So it's not just one country in the West. Consider Japan part of the West here. We know they're all in trouble. Government debt too. The average citizen out there who used to feel comfortable putting money into government debt, if he has doubt about that, whoa, that's like a nuclear event. I mean, where do you put your money? It used to be the alternative, the place to bank it safely. And if that's in question, foreign investors in U.S. bonds, if that's in question, or U.S. citizens buying bonds, then the Fed has to buy them. And sure enough, that's what they said they would do in November, and they've been doing it. You can look at a bond futures chart, and you can see, though they've been buying it, it's come down, yields have gone up a bit, and the stranglehold of high yields on the long end, like 30-year bonds, remains at a high level, despite the Fed cutting short rates. That's choking real estate, commercial real estate.